So this is a very simple yet powerful and effective strategy if used properly. I know a lot of traders like scalping, and if you understand the mechanics of this strategy, it's going to make a lot of sense to you guys versus how I see a lot of retail traders scalping. And a lot of you guys scalp over key levels. You guys are buying breakouts or breakdowns below certain key levels, below certain resistance or support levels, which is fine because you could definitely get a couple points off of those levels. But this strategy, 80% of the time when I see this form, it works and I could easily get a quick dollar, dollar 50, even higher than that, even greater amount than that, depending on the stock you're trading. But this works about 80% of the time. And it's very, very powerful if you're going in with large contract size and just scalping for a quick move to the upside, taking your profits and, pretty much running away once you have those profits. It's kind of an emotionless type of trade too. So really fast, let's just get into the key levels part, the resistance and support basis of this. So right here we have Netflix. Yesterday, let's put this into perspective. Yesterday, Netflix rallied up to this 424 level, formed resistance, and then sold off from 424 all the way down to about 414. So about 10-point drop. This is a major resistance level because obviously we had a major reaction off of that level. Stock could not break above this level. So fast forward today, and Netflix is rallying. We opened at 415 and we're rallying all the way up to 424, which again is that key level. So this also aligns with the supply and demand strategy. And in this case, since we're buying a breakout, or I'm not going to really call it a breakout, but we're buying a speculation for a demand zone to form. This goes in correlation with basically speculating that a demand area is going to form, and you're basically buying or longing to the upside for a potential breakout to the upside. So to understand the mechanics of this trade is that we have a rally to the upside. Now this goes, like I said, this is based off of a demand strategy. So supply and demand, this is the demand section or the demand portion of the strategy that I personally use. So we had a rally to the upside. Now this rally, there are going to be institutional activity trading in this area, which caused the market to come up like this. The reason why I know this is because we had an impulsive move to the upside. I know a lot of people are going to comment saying, how do you know institutional activity was in this area? Well, institutions are the ones who move the markets. Joe or Bob that's trading 100 shares, hitting the ask, is not going to move the market up 10 points like this in a violent and aggressive move to the upside. It's basically institutional traders trading with such large size that they can influence the market in such a way that in a 15-minute period, we can rally 6 points to the upside. Now, 6 points on a $400 stock is really nothing crazy, but it's the fact that we had an impulsive move to the upside and we also had no real pullback to the downside. Now, this pullback comes into the strategy, but the part I want you guys to understand is that this rally to the upside is based off of institutional activity. So we rallied pretty much to the upside. And what happens here is that if an institution, let's say, is trying to buy at, I don't know, $418, they had, let's say, a order to buy on the bid at $418, but their order never got filled because price aggressively and violently moved to the upside. So their order is pretty much useless because it did not get filled for this rally to the upside. So let's say institution XYZ missed this rally to the upside. They do not have any position, etc. What happens is we then base out near the highs. So we rallied up. Next candle is a 5-minute candle where we based out. Now I'm going to zoom this out, go into a lower time frame and show you what this looks like in a lower time frame. Again, rallied up in the morning in this area, no real pullback to the downside until we get to this area. Again, this lines up with a key level, so it also comes in confluence with each other. It's double confirmation. It gives me a pretty good idea that this trade is going to be a high probability. It's an A plus setup, and I'm going to look to go larger size on my scalp on this trade because I know that this works about 80% of the time, and this is going to cause a strong move to the upside where I could get a quick entry and a quick exit really fast, take my profits, and call it a day. So, institutional activity, orders did not get filled in this move to the upside right here. Now what happens is price starts pulling back and somewhat looks attractive to the downside. So you have retail traders now selling or shorting in this area because again, 424 key level. Let me see. So 424 key level. And if you look on a 1 minute chart, we're starting this downtrend. Somewhat looks like we're going to start to come down. A lot of traders get short here, putting their stop above the high. You have to ask yourself that who is buying to the people that are selling and sold off on this move from 424 to 421-ish. You know, for every buyer, there's a seller, and for every seller, there's a buyer. So you have to ask yourself, you know, who's selling on this upside in the morning and who's buying on this sell-off in the still the morning, but who's buying based off this sell-off. And I can tell you who's buying here because this goes in with the speculation of the scalp that we're about to take. Market starts selling off, not selling off, but you know, somewhat of profit taking and just selling in this area. Who's buying? The people that are buying in this area right here are institutional traders that did not get their order filled off of this level right here from the first rally. So everyone's selling here and they are providing liquidity to institutional traders for another move to the upside. So because they missed their order here, they have to get filled now up here for another leg higher. Price pulls back, fills their orders, and now that their orders are filled, they're going to make the stock rally to the upside so they cannot lose on this trade. So I'm going to go on a 5 minute chart, and this only works on a 5 minute chart. It also will work on a 15, 30 minute, whatever, 1 hour. You'll see the same type of candlestick formations. But in my opinion, for scalping, using this on a 5 minute chart works the best for me. So here's two important things I want to see. I want to see a strong rally to the upside, an impulsive move, which goes into our strategy that there are unfilled orders, or there are orders that did not get filled here. So they have to make price look attractive to the downside to get filled for another leg higher. So it's important that the first move up is a very strong impulsive move up and closes near the highs on this green candle right here. We need to close near the highs. It could be at the highs or it could be near the highs. You know, if the candle closes, let's say down here, I'm not going to look at this as a valid trade. It needs to close near the highs. Second concept is that the next candle from the close near the highs needs to be a bearish candle. It needs to be a red candle, and it will work the best when you have a lower wick showing buyers are stepping in down here. So a red candle is very important, followed by a candle before, which is green, a strong rally to the upside, close near the highs. Now I'm going to play this. We're on demand. Now what we're going to do is we're going to look to play calls. So let me go into my options chain. So this is based off of an active trader setup. I'm just going to play at the money calls. I'm going to load them into my second graph. Put Netflix back here. So this is just what I do for scalping. So it helps me with faster executions. And also beware of your spreads. So if the spreads are tight, my rule of thumb is about 7 cents. If the spreads are tight, it's safe to market order in. If the spreads are anything over 7, 10 cents, look to limit order, and you could limit order based off of this active trader. So I don't know why Netflix is not loading. There we go. Okay. So now what I'm looking for is a break above the high. We have our rally, we have our base. Now we're really speculating that a demand zone is going to form here. And we're going to basically buy the breakout over 424. This is important candle structure that I look for. I have my Netflix calls loaded into my active trader. And now I'm pretty much going to market order in if my spreads are tight. the spreads are close, under 7 cents, I'm going to market order in. I'll link this active trader video. I have a lesson on how to use active trader. I'll link it in the description if you guys want to see that. But basically I'm just, have my finger on the trigger ready to go, and I'm looking to market order in. If the spreads are tight, above 424, we get above 424, and now I'm just market ordered in. And now really what I'm looking for is a quick dollar. Any quick impulsive move to the upside, I'm scaling out half my position. So a quick move to the upside. Personally, what I do is, for my strategy, is I sell at least half of my position, a quarter of my position, lock profits in. Just so if the stock then again turns against me, I will have some profits locked in, and I could prevent the trade from becoming a red trade if I lock some profits in. You can never go wrong locking in profits when you do have them. So let's see what happens. We really have no rejection yet. We have a whole dollar now from 424, and let's see what happens. So again, this is on demand. So this is all in active trader. On demand. So this all has happened before. So now we get that impulsive move. I'm selling half, and then I'm just going to let the rest ride. This trade becomes invalid if the green candle that we currently trade off of turns red or breaks below the low of the open. It becomes invalid, and there's really no definitive exit point. It's really subjective looking at the S&P 500, looking at you could even go into a 1-minute chart. But it's really all subjective. My exit is planned out. If we come and make this a red candle, I'm exiting. Okay, so here's another example. Again, you need to have a strong rally and impulsive move that orders cannot have got filled by institutions. Because of that impulsive move, they could not have got filled at the desired price they were looking to enter at. Now we have a basing candle. This green candle closed near the high. This is now a basing candle, like I said, a red candle. We have somewhat of a wick, and now this forms a valid demand zone. So we're buying calls above the high, which is right here, out of speculation that demand is going to form, and out of speculation that we're going to break out to the upside. And you could have got, from, if you broke above the high, from 2297 to 2313. So that is 17 points, 16 points to the upside in a matter of under 5 minutes. And if you're scalping Amazon and getting 17 points in under 5 minutes, you're easily making at least 5 to 7 points on the option contracts, easily. So that's what I look for. A rally, then we base out, and then we're buying speculation out of demand forming, and we're buying above the breakout, above the high. Again, here's another example. We're going to look at Tesla. So put into perspective, major rally the day before, major rally in pre-market. Now we open up and we have a strong rally to the upside. Close near the highs, form a high. Now next candle is a red basing candle. Next candle now, this third candle, which is the green candle, open up, come above, break above the high. This is 716, and this candle closed at 726. 10 points on Tesla in under 5 minutes is going to yield you a great percent return. Again, your entries are fast when you're scalping, and your exits are even faster. It's very simple and yet very powerful strategy once you understand the reasoning behind it, and once you understand and start seeing these candlestick formations form in real time.